Tortoises, I've been investing for 8 years, and in this video, I'm going to show you every key investment mistake I made at the beginning of my journey so you don't have to repeat them. Now, some of those mistakes cost me real money, like blowing up a 10K account. Others just cost me a few gray hairs and a lot of time. Either way, I hope you get to skip all of them in the next 15-20 minutes. Of course, today I run my portfolio calmly, as I've been preaching on the channel ever since I started it. I spend no longer than an hour of my time per week towards my portfolio allocations with a process that is both trustworthy and profitable. However, that's not how it started. The way it started, CFDs, margin calls, revenge trading, you name it. And if those concepts are not familiar to you, I'm so glad that is the case. However, what we will be doing throughout this video is breaking them down so you know exactly why you should avoid them in the first place. So let's do that right now. To make everything clearer to you and really get my point across, I decided to put together all the relevant mistakes into a Word document so you guys can read all throughout. And that's exactly what we will be discussing right now. Starting with mistake number one, I traded CFDs without understanding what they were. And I know so many people who have been guilty of this mistake. In fact, I'm not sure. Some of you are already long-term viewers of the channel, and I'm so glad for you to be around. And if you are new, welcome. And one of my testimonials is with someone who has fallen into the trap of using CFDs without really knowing the consequences of that. That is Lucy, that you can find right here. There is a case study if you want to hear more about her experience. But this is definitely a mistake that you should avoid at all costs. My first investments weren't investments at all. Let's start with that. There were CFDs, contracts called contracts for difference. Here's what nobody told me, and what I didn't bother to find out. With a CFD, you actually don't own anything. No shares, no piece of a business. You are just betting on which way a price moves. And on top of that, there are overnight fees, and fees killed me, guys. Spreads and leverage quietly working against you. I thought I was investing in great companies. I was actually speculating on price direction without owning the underlying assets. With a house taking a cut every single time, every single day, because CFDs, as the name, in case you don't know, I don't think, oh yeah, it's right here, contracts for difference. So when you buy this, guys, and you can look this up if you don't know its meaning, but you don't own shares of a company. You are essentially betting on the price direction. In many cases, I was not really going short. In some cases, I would buy like oil or natural gas, and then I would short the next week. But more often than not, I would just go long on things that I thought that in my opinion would appreciate over time, because most of my trades at the beginning of my journey were commodity related trades. And we know that, commodities typically tend to do very well in an inflationary environment. We don't need to be experts. And so I thought, okay, let's try oil. Why not? Let's give oil a go. And the problem is that even if you are right, because you don't own the underlying assets, and you own a CFD, the fact that the trade stays open for several days is costing you a lot of money. The fees that you will be paying are ridiculously high. And because I really want to show you exactly what that means, and give you a visual understanding, let's go right here to eToro, to our eToro account, which I use for educational purposes. As you can find right here, this is the virtual account. But let's say I want to trade. You can see I can put an amount, say 5K, doesn't really matter, just to give you an idea. Let's say 5K, right? So if you do X1, that means you don't pay overnight. You are not buying a CFD. However, if you use 2 times, look, now you are trading CFDs, and then because you are using CFDs, you can see what the overnight fees will look like. Okay, and this, guys, is really what crippled my returns. Even though I was making some of these trades were profitable, after accounting for those exuberant those exorbitant fees, then I was actually losing more than I was making, which was quite painful. However, I didn't have the knowledge that I have today, and so I didn't know exactly what I was doing. So I hope that makes sense, and hopefully this will save you a lot of trouble. Let's talk about mistake number two. I kept funding my accounts after margin calls, and this ties into mistake number one because I was having a lot of so I was the number of fees was going up. So eventually, I was running, my cash position was going down, and eventually I faced margin calls. What is a margin call? When you get an email or a message from your broker saying, hey, you have to fund your account or we're going to have to close a few positions. So that was mistake number two. If number one was ignorance, mistake number two was denial. A margin call is your broker telling your position is losing so badly that you need to add money or reclose it. That message is definitely a fire alarm. You know what I did when the fire alarm went off? I poured in more money because I didn't want to face those losses. In some cases, I had, for example, I remember back in 2020, was it 2019? I think it was 2019. I was trading Palladium and the overnight fees were already minus $900. And I kept putting more money to leave the position open because I believe that one day it will Palladium was actually trading. We're going to go trade in the right direction, and I would make money. And that's not how it worked out. The fees continue to go up. They continue to inflate, and eventually I have to close the position at a much more significant loss. All right. Each deposit felt like protecting my position. What it actually was, throwing good money after bad into trades I had already lost. The lesson: a margin call is not an invitation to top up. It's the market telling you your position size was wrong from the very beginning. When the fire alarm rings, you leave the building. You don't move more furniture in. That is something that I really learned the hard way. And look, needless to say, today with my investment process, with my framework, I don't even have to use leverage, and I don't think you should use leverage because think about it. What exactly do we do today? We buy high quality companies when they are significantly marked down. So when we have a significant margin of safety, doesn't that give you enough leverage? Absolutely does, because you can get a quick double or triple in say 3 to 4 years and surpass the S&P average returns over the last several decades. That gives you a lot of leverage in and of itself. And you have time in your favor instead of having it against you. So mistake number three, I traded my emotions and chased losses. This one was the most expensive, not in fees, but in judgment. After a losing streak, the goal quietly changed. I wasn't trying to make good decisions anymore. I was trying to prove I could make more money. So every new trade was about winning back what I had lost and repairing my ego. I don't know if there is a proper name for this, if there is like a human bias at play here. However, I really fell into this trap. And I remember this vividly, especially with oil. I'm only mentioning commodities, but I traded stocks as well. Initially, I did everything, but mostly stocks and commodities and also crypto. But after losing money, I thought I had to prove myself capable of making money. And so I tried to repair those past mistakes. Needless to say, it went horribly wrong. That's called revenge trading, and it has a near perfect track record. It turns small losses into huge ones. So the lesson is the moment the trade is about proving something, you have already lost. The market doesn't know you exist, guys, so it doesn't owe you your money back. The way you can mitigate this issue is by understanding what you own. And look, if the thesis changes, you should leave the investment. Even if it's a great company, maybe you didn't understand it as well as you thought in the beginning. And so if the story changed, so should your investments. And then you should just take the loss and move on. Mistake number four, I started without understanding risk. Many people that come to me, unfortunately, fall into this trap as well. Underneath all of this was one root mistake. I started with real money before I had real knowledge, and I continue to see so many guys that come to my channel and leave comments. For example, I remember some comments that I read on PayPal. Because of this video of yours, I'm opening a position, and they don't actually understand what PayPal does. They are opening a position just because I mentioned that I have portfolio in my portfolio. Excuse me, that I have PayPal in my portfolio. Number one, I always stress that everything that I do here is for educational purposes and not financial advice. Number two, I never make any investments, no matter how great the company, without understanding risks and without understanding the company very well and get comfortable with the company. Your situation, your risk profile, your temperament, your goals may be entirely different from mine. And so your strategy may not be exactly the same as mine. I hope that makes sense. So understand exactly the risks before committing your hard-earned money to towards any investment at all. The risks are not hidden; they are all knowable in insight. But you have to consciously go and learn them before your money is on the line, because the market charges very high tuition for lessons you refuse to learn for free. Another way to mitigate this risk: do what Charlie Munger always did. Whenever you want to find whenever you want to find a solution to a complex problem, just do inversion, right? So, in other words, try to understand what are the things that could disrupt the investment thesis, what can go wrong with the business, and then try to come up with a solution for that. And what you will find is that this will allow you to be well aware of the risks with an investment before you deploy that capital. Okay, so you will sleep comfortably at night. Mistake number five, I followed other people's ideas without understanding them. Again, I mean, so many people fall into this. Even when I moved toward real investing, initially I carried one nasty habit with me: buying things because someone convincing said so. I would go to the Dataroma, check the portfolio of the world's most successful investors, look at their positioning, and then I would get ideas without doing due diligence. I would simply buy them because I thought, because these guys are so smart, then surely this trade will work very well. And the problem with that is, because you don't know that investment, you don't understand it, then if it goes against you, as it often will, you will panic and you will sell, right? Instead of perhaps buying more. That was my mistake. The problem, and it's subtle: when you buy on someone else's thesis, you can't act when things change. Price drops 30%. Is it a buying opportunity or a disaster? Oh my God, I'm stressing. You have no idea because you never knew why you own it in the first place. So what is the lesson? Borrowed conviction is not conviction. If you cannot explain why you own something in 2 sentences, you don't own an investment, you own someone else's opinion. And that is not going to make you a great investor over time. And if you are watching this still, is because I believe you want to be in control of your financial well-being. You want to be in charge of your financial decisions. And that means you have to be fully comfortable. You have to be fully comfortable when it comes to understanding what you own. Otherwise, how else will you be able to outperform? The turning point: blowing up a 10K account. Yes, I'm guilty of that. And I have to confess, I'm very happy that I'm not in the position of some of the people that come to me. Some of them destroyed much larger accounts, let's put it that way. But anyway, 10K is quite a lot of money, and it certainly was for me back then. All of this ended the way it usually ends. I blew up a 10K account, and honestly, that loss was the worst thing that happened to me, because it forced the question I had been avoiding: was I going too quick, or was I going to finally do this properly? I stopped completely, no trades, and I started from zero. Learned how to actually read a business, build a repeatable process for finding and analyzing companies, defined my rules before entering positions, and slowed everything down. That process eventually became what I now call the Tortoise method. 1 hour a week, businesses I understand, rules I follow, no leverage, no margin calls, no speculative things, no revenge. The hare in me lost 10K, but the tortoise made it back. I hope you like that last one and just kept going. So let's recap everything, guys. The shortcut list, everything I paid for free for you. Know what you actually own. CFDs are just speculation. They are a financial instrument that is speculative driven. You don't need that. Stay away from it. The only thing that wants you to trade CFDs is your broker because they make a lot of money at your own expense, okay? At your own cost, excuse me, at your own costs. Not investing. A margin call is an exit sign, not a deposit request. If a trade is about proving something you have already lost, learn the risks before the money is on the line. Borrowed conviction is not conviction. And if you haven't already made these mistakes, the account can blow up without you blowing up. It's a restart, not the end. And by far the best way you can go about mitigating some of these mistakes is by investing in your education. As you can see, I'm in Portugal right now, and I have quite a lot of books that I continue to read. I love reading books. Here is another one of the books that I read this year. You guys are familiar with this, Nassim Taleb, Black Swan. Yeah, so very cool. Another book that I started reading, Prática Contabilística. So this is Portuguese. It's accounting. Yeah, yeah. You don't have to be an accountant in order to be a successful investor. However, accounting is the language of business, and so the more you learn, the more you earn, as Warren Buffett told us. And yeah, so keep investing in your education and reach out if you have any questions, doubts. Let me know in the comments below if you like this video, guys. Stay safe and let's be a tortoise as always. I hope you don't make any of these mistakes, but have you made them? If you have, let me know in the comments because I want to know that I'm not alone. Thank you, guys.